All right. So today we'll talk a little bit about mutual funds, real estate, and other investment alternatives. So again, mutual funds are not a whole lot different than usually the underlying stocks that they're made up of. But they don't necessarily need to be made up of stocks. They can also have bonds. And there's also mutual funds that involve real estate. So mutual funds are just a broad concept, but they're very easy, very user-friendly to deal with. If you haven't invested at all, they're probably where you're going to start. Either because if you have a company with a 401k, very rarely will you be buying individual stocks, and you'll end up in some sort of mutual fund. Lots of good companies out there. Like I say, the key things you're looking for are probably no-load mutual funds, and after that, it's just you can find whatever fund you want in terms of really whatever sales pitch you're kind of susceptible to. They all claim to want to do great things for you, but whether they can actually deliver, it depends. And again, there's always going to be trade-offs between, the maximum yield and the maximum safety. So you can get a very, very safe mutual fund that's nothing but, say, government treasuries that's not going to have much of a return at all. Or you can get something very risky that's made up of, of high yield or leverage type investments that they can be quite risky. So characteristics, mutual funds, purposes, and how they're bought and sold. So, like you say, there's more mutual funds than there are individual stocks. In 2009, so again, this data is getting dated, but 12.2 trillion seems like a lot of money, but then you look at our national debt that's approaching 20 trillion. So, what's that? We're getting there. Yeah. Yeah. What's that?
Last time I looked, we were at like 17. I didn't know.
No, I think there's different estimates. We'll look again. We'll have time at the end, but you're probably right. I think I was probably looking at maybe a pessimistic forecast, but the thing is, I think we'll both be right. If it's 17 million today, it'll be 20 million by the end of whatever, shortly. It's out of control.
18.1.
Is it 18.1 right now? So we'll both claim victory there, right in the middle. The major reasons, I also saw a different thing, though, that said the true, and I don't know why I didn't read further in their description, but they were saying the true national debt was 65 trillion. But there's also a notion of unfunded liabilities. Like some of these cities, like you look at a place like Chicago, and they have so much money obligated to pension plans and other things, teachers and firemen, that they have no way of paying that back. So anyway, but on to brighter news. Talk about ISIS or something cheery. But anyway, why investors purchase mutual funds. So, this notion of having the professional management, the fund manager, that is one reason that some people look to it. But again, we've also talked about certain mutual funds just being index funds with very little management being involved at all. Again, the reason people are driven to that is for lower expenses, and also finding that some of these fund managers are just generating a lot of activity, but not necessarily a lot of returns. The other thing is, too, if you buy into some, fund because it's got a great manager, well, those managers, it's like sports teams. They trade around and stuff. So you still have to make sure they're part of the team if you're getting involved with that. Be aware of the scandal involving league trading. There's always going to be scandals. But if you stay with the more reputable companies, you're probably not going to be involved in that as much. And again, there's plenty to choose from. I'm not recommending anybody, but if you go out there, you got Fidelity, Vanguard, T. Rowe Price, Strong, American Century. There's so many big players out there, and those guys are generally not in in the scandal business. They've stayed mainly free of that compared to some of the investment banks. Diversification, that is probably the best reason, actually. I would not say the professional management is in there, but the diversification, the ability to own across a whole sector of investments. You want, it's kind of the best of both worlds. Again, with the one predicate that maybe real estate is maybe a better investment in my mind in a lot of ways. But if you are going to be involved in equities, stocks of companies, if you're involved in it to get that, capital appreciation, to mitigate that risk of that exposure to, the vagaries of individual companies, you can go with a mutual fund. And again, there's lots of ways you can diversify here. You can buy, across a whole industry or index that would, give you exposure across the entire economy. Or you can say, well, I know this one sector is going to go, healthcare or pharmaceutical or one region is going to go, and I'll invest in that region, but I want to, spread myself across 10, 20, 50 companies. They aren't all going to be winners, but somebody's going to make it. High-tech type things like that, So again, you can get involved in maybe stocks that would be potentially too risky as individual investments, but grouped together, you get some diversification and a little bit of safety. Closed-end funds, we're not going to talk too much about this. The notion of closed-end funds is some of these behemoths, there used to be like Fidelity Magellan, just this mammoth fund. When they take a position in a company, just the fact that there's this huge elephant of a fund, when they come into a company, it distorts the price. It's all about supply and demand. And so when one of these big bond fund companies comes in and starts buying up some small company, well, it's no longer a small company, and it has a ripple effect across the market. So there are certain funds that have tried to, they don't want to necessarily be the biggest. They want to limit where they are so that they can still move in and out of the market without huge impact. So that would be a closed-end fund. Exchange-traded funds, ETFs. So, funds that invest in stocks contained in a specific index. So, we talked a little about that. Open-end funds, so that's the predominant ones. Buy and sell shares at net asset value. So, that's just a term that just means that at the end of the day, let's say this particular stock has, or particular mutual fund owns positions with 80 different stocks. Well, to give a running tally throughout the day of their positions, you could do it with computers and all, but they don't. They wait till the end of the day, and they look at what the closing price for every one of those stocks that they held is, and they look at how many shares of each one of those they have, and they divide it by the number of shares outstanding in the mutual fund, and that'll give them a net asset value. So anyway, but when you buy and sell mutual funds, you sell at the end of the day closing price, that net asset value, as opposed to stocks that you trade throughout the day. The end of the day is just the end of the day. It's not really a point in time. So again, if you're trading stocks, this whole watching the ticker and selling and being very timely about it is a big deal. With mutual funds, no, your big deal, at least here in Alaska, is noon. 4 o'clock Eastern time is when the markets close. If you have your order in, at anywhere between whatever time in the morning and noon, you're going to get the net asset value for that day. Here's what they're showing. So the value of the portfolio, which I described, all their positions, and then minus their liabilities, if there are some, fees or something outstanding, and then the number of shares outstanding. Loaded fund, don't do it. The problem with loaded funds is you don't have to do it, number one. There's plenty of options out there. It's a competitive market. So loaded funds usually come from some salesman trying to sell you something, and they want a commission. Obviously, their family's got to eat and the rest of that. I understand that, but basically not on my back. And the other problem is that this load is going to come out early. It's going to come out before your shares have appreciated at all. So time value of money being what it is expensive. So if they want to, they don't typically do this, but if they wanted a back end load where they get a percentage of the gains at the end when you sell, well, then they'd have some incentive, some skin in the game. But if they just want a chunk of my initial investment, I'm not interested in that. So no load funds, you deal directly with 800 numbers or websites. So yeah, you're dealing with websites pretty much. The 800 numbers right now, again, it's like travel agents. It's just not as easy. You can do it better graphically and everything else on the website, and that's typically through the discount broker. So, anybody have discount broker's account set up? Schwab, E-Trade, anybody? It's just that easy. Who do you trade with? Schwab, and they are how much to trade?
What was that?
How much per trade do they go for?
It's a good question.
It's not much. It'll be under $10.
Very minimal fees.
About $7. Well, I think I'm paying $7, $8.95, something like that. But anyway, if you're buying increments of say between 1 and 3,000, for some reason I usually buy in increments of about $3,000 at a whack, and so $8 on that going and coming. There's going to be $8 to buy and then $8 to sell. So $16 is a percentage out of $3,000 is not significant. So anyway, that's where you do it. And, getting one of these accounts established is very, very easy to do. Usually, if you have an existing, relationship with a financial institution already, you might want to go with them. But perhaps like Schwab or E-Trade or Scottrade or whatever, sometimes they have some tools that help you do research, or they have a benefit for members for where they have access to Morningstar or some sort of financial document, so you don't have to get an individual subscription with those guys. That might be a reason I'd go with those guys. But in terms of what they do and how they do it, it's kind of interchangeable. Contingent deferred sales loads, so back end loads, 1 to 5%, generally decrease the number of years. But again, you don't see these very often. I mean, in concept, it's a good idea. Because now, if I turn my 100,000 into $1 million, that's what we're both on that. We both have the same objectives here. If it's just a loaded fund, they're getting their commission up front, and they take their commission and they're done with me. I'm more interested in somebody, if I am going to go with this deferred sales load, or a sales load to have taken off the back end. But again, there's plenty out there in the market that are no load. So why you'd want to do this? Any loaded funds is just not something I do. So management fees, 0.5 to 1% based on percentage of funds. So it depends how much management they're doing. Again, if it's an index fund, the management fees ought to be almost, getting down to very, fractional percents there. 12B fees. This is part of, this is not necessarily considered a load either. It's just part of the cost of doing business. But again, if a mutual fund says they're making, 15, 20% for you, that's after these fees are subtracted. So, they had to do a little better than that. And I don't mind paying a hefty management fee if they're delivering. But if they're getting returns that are, fairly anemic, then what exactly are they doing? That's better than an index fund with no management fees. Expense ratios. So again, management fees, operating fees. So you just need to look when you're evaluating mutual funds. And again, you probably use something like Morningstar, and you look at the different funds, and they would have these fees specified in there, but they would also have their returns. So you just need to make sure that if the fees are high, the return ought to be fairly high. The tough thing is that you're not so interested in historical performance. you're more interested in what they're going to be doing in the future too. So if things are cyclical, there is a danger for getting in on the top of some sort of fund. But if you're dollar cost averaging, which means you're making regular investments, say like $100 a month from here on out, these kind of spikes in performance will even out. You're looking for a long-term performer. So different mutual funds, will be described by what their objectives are. So if it's aggressive growth, you're not going to be getting any income. You're not going to be getting any dividends. They're buying stocks in small, fast-growing companies that are expected to, definitely outperform the market, and they're still growing. So they're not. The concept of giving dividends is they're not a mature company yet. They're not to that point yet. Equity income funds, a long history of paying dividends. So these are companies that are much more mature, and probably something that people get involved in that are, usually the customers for those sorts of funds are more mature. They are more interested in living off the dividends of those funds, whereas somebody who's young is generally more invested in or interested in growth. Global stock funds. So there's a difference. It's a subtle distinction, but it's there between global and international. Global means they can invest in anywhere, the U.S. included. International means that they're, per the definition, is U.S. investments are excluded. But the whole thing now is kind of a mess, because where companies are located versus where they're actually located it's usually a lot of financial gamesmanship right now. There's a whole bunch of companies that are based out of Ireland now because they're just inversions. Ireland has got low corporate tax rates. So you buy some small company in Ireland, you move your headquarters there, you claim you're an Irish company. But, is Google Irish? Is, some of these big companies Irish? No. But that's how they work. What do you call it? Burger King bought out Timmy Hortons, the coffee chain up in Canada. And now Burger King is a Canadian corporation. Just about, whatever percentage of their business is done in the United States. But when it comes to the IRS, they're a Canadian corporation, and therefore they're taxed at a lesser extent. So until the U.S. gets their tax rates down, we're just not competitive. So anyway, so for some of these mutual funds, it depends what your objectives are. Growth stock funds, higher than average returns and earnings growth. So aggressive growth versus growth. So it's just a level of magnitude. Index funds. So these are the guys who buy, very little. The deal with this is you're trying to minimize those management fees. You're trying to minimize those sales commissions. So you buy, a range of stocks, and it can be aggressive or not. I mean, you can buy across NASDAQ, which is probably going to be quite a bit more volatile than, say, across the Dow Jones. Dow Jones are one of the established stocks. So international funds, like I said, buying outside of the U.S., and then large cap, small cap, mid cap. Anyway, that has to do with capitalization, right? How much money they've got. So 10 billion or more would be a large cap. So again, more established company, a little more probably sluggish. There can be some variations, but as a broad generalization. So mid caps up 2 to 10, and small caps smaller. Regional funds. So you can find funds that invest in pretty much any region you want. It can be from all over the world, the emerging companies, brick type things. It can be, I'm sure you can find one for Vietnam, China, whatever you want. And you can also do that with stocks. There was a travel company. It was like a Travelocity kind of equivalent that came up on the. It was a Chinese company, but they were selling their stock through the U.S. So you do not, in most cases, want to buy stock on a foreign foreign stock exchange, because you'll just generate a nightmare's worth of paperwork. But you can invest in foreign companies that are part of mutual funds that are traded on the U.S. exchange. A lot of times you'll get an extra tax form at the end of the year with, foreign taxes paid and some other things, but it's just another tick in the block when you're doing your taxes. Not a big deal. But they hold the positions in these foreign companies, and you hold it only indirectly, so you minimize a lot of that headache that you'd have. Sector companies or sector funds, so we talked about that. Again, whatever you're interested in, it could be automotive, defense, pharmaceutical, high tech. You pick the fund and you can do it. Small caps, we know about that. Socially responsible funds, I've never been one for these, but you can get ones that, will not do business with anybody who, does business in certain countries that have, bad reputations or only invests in, solar, type companies or whatever. There's just, anyway, they're out there. And then you have bond funds. Now you can have mutual funds that also have some stocks involved in them, or you can just have ones that are exclusively bond funds. Like I said, I used to have a short-term bond fund. At a time, it was great. It paid 8%, and it was just solid. I have no regrets with that. But high-yield junk bonds, I would not pay that. Intermediate corporate bonds, U.S. bonds, long-term corporate bonds. Anyway, so whatever configuration you're interested in, the deal with bonds is kind of like stocks. If a company goes out of business, a bond is essentially an IOU from that company. So by being spread across more companies, your risk is a little bit less. If you were holding, say, bonds in General Motors, you kind of got clobbered when they almost kind of declared, well, I guess they didn't declare bankruptcy. Anyway, the government came in and they had no sympathy for private investors. They got clobbered. The unions got taken care of, the government got taken care of, but the individual investors, they took a haircut. That's what they call it, where they get pennies on the dollar for their investments. So anyway, you can lose money on anything, and by being in a bond fund, Vice having just an individual bond might be easier for you. Long-term U.S. bonds, so treasuries, munis, and short-term corporate bonds. Again, before you jump on, I want the muni bond because it's going to be, tax-free. Well, make sure that the yield is reasonable. The yield will be less than the taxable bond, so you have to do that calculation where you use your tax rate and you do the math and you figure out whether it's competitive or not. But certain people just gravitate to tax-free bonds, so in my mind, they're usually not as good a deal because there's an inherent supply there where people hear the word tax-free and they glom on it, and it doesn't always make it a good investment. Short-term U.S. bonds and world bond funds. So, anyway, any of these ones that are in U.S. securities, treasuries, they're not paying more than 1% these days. And world bond funds, you'd really have to do some due diligence to study up on what particular, country you're looking at. But the way things are going right now, there's a lot of instability out there, and there's a lot of things well beyond your control, especially for an individual investor. So I wouldn't really be driven to those types of investments. Asset allocations. So we showed some examples of this last time where you had these sort of, life cycle growth funds, whatever, where they, start out fairly aggressive when you're young and then will switch to more of an income type thing, and they'll manage that asset allocation over your life. Balanced funds invest in stocks and bonds, but right now, I don't want any bonds, so I'm not interested. It's I'm gonna any degree, any percentage that's going to be long-term bonds is a guaranteed loser. So right now, so I'm not interested in that. And you have to read the prospectus, because the fund manager may want to get out of bonds right now, but per their prospectus, he's tied to the investments. The prospectus will put kind of the rules of the road. It'll say, the fund manager's main goal is, capital appreciation. To achieve this goal, he will maintain, 50% in equities and 50% in bonds. Well, if that's the fund you signed up for, don't expect this guy to take a stronger position in stocks and diminish his position in bonds, because he's locked into it per the prospectus. So, a lot of times some of these prospectuses tie the hands of the fund manager, so they really can't do a whole lot of management. They just got to sit there and watch as well, because they're tied in per the agreement. Funds of funds. I mean, this can get even more complex. Now you can get mutual funds that have mutual funds within them, and life cycle funds, which we talked about, because that's really more of an asset allocation. Increasingly conservative is income. So again, same thing. Money market funds, invest in CDs, government securities, and other safe instruments. But again, safety and the reason why they don't pay anything is because they're very, very safe. So locking in a yield that's going to be below inflation is not my objective. So if that's what they mean by safety, then I'm not interested in it. So family of funds, you can go to any company and any company that's fairly large, and you will see their whole family of funds. They've got funds that will, and a lot of times it's competitive amongst the various funds. When I say there's like somebody investing in say Brazil, I'm sure Vanguard, I'm sure Fidelity, I'm sure all these different guys all have their one fund that specializes in Brazil. But anyway, they'll have a whole bunch of other ones under that company, and that will be their family of funds. You can transfer back and forth. So I'll do this sometimes. If I know, and again, market timing is kind of a dangerous thing. Doesn't always work. But anyway, let's just say, bad news is coming, that the market is fixing to plummet. I will go ahead and exchange shares. I'll trade shares out of my equity fund that's invested in stocks and stuff, and I'll put it in a money market or in a treasury account and just sort of park it there until the turbulence stops. Do I guess it wrong sometimes? Once in a while. But sometimes I've been right, And so when you're talking a fair chunk of change, and it's not hard to do. Now, the mutual fund companies, they don't like so much people jumping in and speculating and doing stuff like that. Don't get yourself in trouble. I mean, and who cares if I'm in trouble with the mutual fund company, other than they won't let me, they'll maybe allow, let's say, 4 trades a quarter or something like that, of big moves, which is I'm not that aggressive. I'm not day trading with this account. But if I see something bad on the horizon, I've done this before. I'm driving back from, Willow. I'll stop in Wasilla at the Kaladi Brothers before noon, do a quick trade, park all my money in government securities, and then, see what happens with the market if I'm anticipating a big dive. Again, timing the market, I'm not, whatever. I would not be up here teaching if I was that good. But
so what do you want, the AM dial or the FM dial when you make those decisions?
it depends. You can learn a lot from the FM dial as well, but you have to be smarter. You have to be able to infer. It's what they don't tell you. When they're talking about everything else, when it's all, race this or gay that or something, okay, the economy's in the tank right now, because they don't want to make any bad news. They don't want to put any waves out there. On the AM dial, if you bite off on that, then you get, caught up in the hype, and you can make bad decisions as well. So, Mark Twain, somebody quoted him, and what they were saying was and granted, in his day it was newspapers, it wasn't the internet, but he said to not read the newspapers is to be uninformed, and to read the newspapers is to be misinformed. Everybody's got an angle out there. There's nobody who's on your side. You have to listen and compare and try and figure out what's going on. But it's a dangerous game. Yeah, but I try not to be that reactive, and I certainly, you can get yourself in a world of hurt. Plus the other thing too, and not to get political here, but do not fall for the understanding that the financial, the stock market, the big money is controlled by one party. Both parties, in fact, even the Democrat Party, who you would not think is the controlling, they're more tied to Wall Street than the Republicans could ever dream to be. So when things are whatever, their people are very, very much tied in, which makes the whole Wall Street. What did we call that thing a couple years ago? Occupy. Kind of funny because it's the same folks. They're all tied in on both sides. And the people who win, they win regardless of winners or losers. And they may have positions on the other side that they're, they want it to drop just as much as the next guy or want it to go up. So it's a scary, scary thought. There's a guy, George Soros. Do you ever heard of George Soros? Made a ton of money. He bet against the Bank of England. But that's where he made his money. And now he's a huge, financial guy. Anyway, so families of funds, we talked about that. Managed funds versus index funds, I think we beat that to death. You understand the concept. Do you have faith in the manager? Do you think he's better, or do you think, it is what it is. The market's going to go up or down together, and I'm just going to buy across the whole index. So again, it has to do with ideological type things. Yep. So again, the reasons for index funds, majority have failed to outperform, and those managed funds are charging a management fee in excess of 0.5. They're usually 1-2%. So you have to look and see. Is there some rock star fund manager out there, or is he just a schlub who got lucky once or twice and over the long haul isn't really delivering? So anyway, in terms of actual sites, you can go to Yahoo Finance to get quotes, but Morningstar is the more reputable one. Smart Money, Business Week, they're going to be a bit behind the times. The problem you gotta avoid here is sort of the Money Magazine type thing, where you're looking at the top performers for last year, and you end up making mutual fund purchases based upon completely in the rearview mirror, completely what they've done previously, and sometimes things line up for a particular fund manager and they have exceptional yields, and they're kind of one-hit wonders. They may not be able to replicate that performance year after year. There are some out there, the Berkshire Hathaway, which was Warren Buffett stuff. He was able to do that, but when we start talking about those closed-end funds, that's how Berkshire Hathaway was. So you can't necessarily jump in there. So anyway, you have to find out what's good. And Value Line as well. So Value Line and Morningstar are the more serious ones. We're going to do research. But if you're just interested in getting a quote, like we said, you can get that right off your iPhone. I was going to do that. In fact, I'll need to do that for Thursday, where we'll look at some of the information you get right off your iPhone. Because actually, there's a fair amount of information. And there's other apps that you can download. I've got another one that I use that gives me real-time quotes. It doesn't make a huge difference, but I just noticed with a penny stock that I still own, the quotes that come off of iPhone are not always accurate. So how do you reach the mutual funds section? First off, if you're looking in the newspaper, for mutual funds, maybe it's all right, because mutual funds are not, they're settled each day. But the ticker name, net asset value, net change, year-to-date percentage. So there's not much in there to actually track. But what we'll do on Thursday is we'll actually look at the iPhone application, because that's probably more relevant. That's where you're going to see it. But we know what all those things are. The name of the fund or the ticker symbol of the fund, with Google, those are almost interchangeable. Net asset value, that's the worth of the stock, and how much is it up and down, and how much is it up and down for the year. So for me, I like the graph, so I like the more interactive ones where I can span, how's it doing over 6 months, how's it doing over a year, and then you get the day, even within the day type thing. Not for mutual funds, but you can get applications that will show you, they'll actually do the math and figure out how that fund is actually tracking the individual stocks you're tracking and what they expect in that asset value to be. But you will have to, anytime you invest in a mutual fund, you'll have to read that prospectus. And so, it's kind of legalese. It's fairly standardized. It'll have certain elements that it must include. But that information about the fund management and the process and the services, turnover ratio, again, you're putting some restrictions on these folks in terms of what this manager can do. And so I don't necessarily always want, severe constraints on the manager. Maybe you do. But for me, I usually, the reason why I've got a fund manager is you're expecting him to be able to exercise his judgment, which, requires having a bit of liberty in there to actually exercise. Financial publications, they're looking at some of these weekly ones. And again, with mutual funds, especially if you're kind of into that, sitting down and looking at an actual print publication isn't a bad way to do that. If I was going to do that, my favorite one is actually not even listed here, Barron's. So Barron's is a kind of a newspaper thing, but I always looked at it when I was in Europe, and it comes out, I think, weekly. And it was actually more of an in-depth presentation. Wall Street Journal can be good as well, but Wall Street Journal is kind of schizophrenic between their news section and their editorial section. It's like written by two different groups of people. Forbes, yeah, it's got some entertainment stuff. Forbes can be all right, actually, but personal finance and money, I'm not big fans of. And some of this Money Magazine stuff, I just think it's frankly kind of dangerous, because I've bought sometimes funds based upon their, the top stock or top mutual fund of whatever year from Money Magazine. I usually found that they were, at a pinnacle, and they had nowhere to go but down. So you're in it for the long term. You're more interested in funds that will continue to perform. Buying funds, just dead easy. There's a homework assignment there to go in there and look for, some potential mutual funds. But, number one, you may get involved in this through the company you're working for. They may already have a, situation set up with a company. And some companies are clunkier than others. I've used Fidelity, and it's absolutely not a problem. I've got a Mortgage Stanley through a brokerage account, and they're kind of funky, but they don't seem to embrace the small guy as much as some of the other Fidelities, Vanguard kind of people. And most of these guys, even these minimum to open an account, usually that will be waived if you make some sort of recurring monthly deposit with them. So, if you wanted to go for something like as little as $50 a month just to get started, they would probably waive the minimums. And you're just, with mutual funds, again, you're buying in dollar amounts. You're not buying in stocks. So you can buy $50 a month, and that's just fine. Whereas stocks, you'd have to figure out, well, I'm going to buy 2 shares, and you'd have to do a calculation each month. With mutual funds, you can just buy in dollar amounts, and it's easier in that way as well. Income dividends, yeah, taxed as regular income, but usually I use any kind of, there's a tick in the block there when you're signing up, and just specify that you want your dividends reinvested, and that will be fairly seamless. So you'll see each month or every whenever dividends are paid, that there'll be a fractional purchase on your part of more mutual fund, and that just means your dividends have been reinvested. Capital gains, this is when you actually sell. Now sometimes they can actually sell within the fund, and they'll send you a tax statement at the end of the year based upon the trades that have been made under that account. I want to, I'll talk about just a couple more things, and then I'm going to save the real estate stuff for next time, because I want to show you something for your project before we get too far. Okay, so like I said, capital gains. You can also have those reinvested, but you're going to generate typically a document at the end of the year, a 1099 DIV or whatever, to show that some income has been generated, even though you haven't bought or sold that stock, or mutual fund. So a little bit of a tax calculation at the end of the year, but not a big deal. And if you're making huge amounts of money in the mutual funds, you can always sell a portion of those mutual funds to pay that tax liability that they, in essence, generated. So, turnover ratio, the percentage of things that have been turned over within that, under that fund, that manager can be buying and selling stocks, and you're paying him to manage. So there should be certain times when he gets in and out of positions. And that will, again, generate that tax liability that I'm talking about. If it's under a 401 or a 403B, so a 401K, for most of us, and 403B for educators, that's all that'll happen. Purchase options, so automatic investments, probably the easiest and the best way to go. And it also gets in that whole pay yourself first kind of thing. You have it set up to on the 1st or the 5th or whatever day you specify if you buy a certain number of shares or a certain dollar amount, typically. And it just keeps rolling in there. Reinvestment plans, for simplicity, that's usually the easiest, especially if you don't have that many shares. You generate a dividend and it's like, $2 or something. You got this $2 check being mailed to you. It's more hassle to go to the bank and the rest of it. Telephone switching, most anybody can do that. And it's also online switching is more prevalent. But it's one of those things, be careful what you ask for. Just because you don't always want to offer that, especially if you're, identity theft, middle of divorce, whatever's going on. All of a sudden you can see funds being transferred around. Sometimes it's, in certain times, better to have more restrictions on that. Withdrawals, phone, letter, online, etc. Again, I'm usually a little bit more secure. I certainly don't want somebody, with the ability to call up and initiate a transfer unless there's a pretty lengthy process. So I'm not, it's a long-term investment. The number one, if I've got a mutual fund, I've got a manager who's supposed to be taking care of it, which means I don't have to check on it every day. But if I'm looking for fraud, I don't want to have to worry about it, and I'm in it for the long term. So redeeming it, taking money out, withdrawing it is not. I don't need it quite that timely. So any questions on the mutual fund bit? Yes.
Late trading, what's that to watch out for? What is that?
On late trading, well, sometimes there's after hours type trading or late trading where they're. I'll go into more an explanation of it next week. I'll look for an actual example to show you, but insider scandal type stuff where the prices that are posted don't necessarily reflect what's out there. But I'll look for the incident. These guys are kind of reactive in the fact that they published this textbook right after 2007, 2008. So they're kind of on the scandals of the day. Things have changed a little bit now, but there have been some scandals out there. The bigger scandals now have been people manipulating interest rates on some of the exchange securities. But I'll give you a better explanation on Thursday. But in regards to this one, the actual question for here, I guess I really didn't want to. Well, we'll talk more about real estate on Friday, but let me give you a little bit of information on gold and precious metals. Well, what I want to show you, though, and I don't have it on here, is the graph. You need to see the yield of gold in comparison to the stock market, because I can say a lot of things about the desirability of investing in gold, but once you see a graph of annual returns of gold, long-term one, it's, let's see if we can just drag one up right now. I don't want annual.
You can invest in gold, like physical gold, right? And also invest in like gold business as well, right?
Yeah, a lot of times with gold, I was actually looking at gold because the price on it's just rock bottom right now. And typically you invest in, you can do that two ways. You can invest in mining companies and things like that, or you can invest in gold and have it in your safe, usually in the form of like coins or even bullion or something like that. Yeah. I've done that with silver, but let's see if it'll pull it up here.
Seems like each method would have some risks that it came with.
Yeah.
It might be too stiff about moving around a bunch of gold, a bunch of physical gold.
Yeah. So you can see gold prices there. That is not what I would call a line. You know what I mean? If I'm looking for linear growth, remember how we saw the stock market graph earlier, where there's, they're saying about 10% per year. That's kind of like in spurts. We had a huge peak in the mid 70s, late 70s, where it got up to almost 2,000, and then up, down. It's tough to live off that in terms of retirement. You know what I mean? It's fairly speculative. So the other problem with it too, gold being as a hedge against inflation, gold and silver are, they have industrial uses. iPhones, computers, all those things require, gold contacts and silver and stuff like that. So when industry demand, when the economy's in the tank, industry demand for those metals goes down, and so the prices go down as well. And right now, is there a more unstable time in the world? You got everything going on in the Middle East. You've got, Russia reasserting itself. You've got, China's economy trouble, and gold prices are at record lows. That's not the way it's supposed to work. Gold prices are supposed to, people are supposed to go back to gold when things get ugly. And I would argue things are pretty ugly right now, and gold prices are that curve is dropping precipitously. So they're showing. Well, there's some.
Gold in 1970, you waited 7 or 8 years, in a pretty good standing.
Oh yeah. But guessing that, as scary as trying to guess where stocks are going, I feel more confident in being able to do that than I do with gold. But it's each to his own. But again, what we're trying to talk about here is investing and trying to talk about, predictable yields. And I see nothing predictable about any of this. I don't know. I just, yeah.
There's the mutual funds that invest in overseas companies.
Yeah.
The worldwide, the world of investments. Those are kind of real down in the pits right now, and they've been there for almost a year.
Yeah.
So would you say that now's a good time to get in while it's low, or is that all this?
Yeah, well, there's always theories, but the adage that's out there is about trying to catch a falling knife, How do you know where the bottom is? You know what I mean? It seems like it makes sense, but
I mean, they're
golly,
pretty down.
yeah, they're beat down. They are beat down.
So I was just looking at that graph, and I guess one thing that you could say about it is it never stays in one place for very long. So you're going to find out in the next year.
You'll have an understanding. I bought silver at 21, and I think it's down, I don't know, 14, 15. It's not doing well right now. And I bought it a couple years ago because it was an all-time low.
Right.
Well, guess what? It got lower. So there you go. I mean, I also have some Bitcoins. I mean, don't get me wrong, but I don't have huge positions in any
It
of these.
seems like that's probably the nature of investing in stocks anyway.
Yeah,
You never really know. It's kind of like gambling.
yeah. What I wanted to show you on here was there's one of the students who's actually she's already got her retirement or her term project complete and or nearly complete, and she didn't have that much data. But number one, I said, well, once you put it into, if you go through it in sort of like a checklist form in terms of what you're going to be doing in terms of your investing, okay, this is what I'm going to do for insurance. This is my plan with children, and I'll probably have children need to go to college, so I'll use some sort of 529 plan. I'll do this, I'll do that, and you put together that checklist, and the report almost writes itself. But one thing to supplement all that is you can find a lot of different sources out there, but I don't like the ones that ask for a whole lot of personal information up front just to give me a calculation. So I was kind of drawn to this bankrate.com one that's got some retirement calculators in there. You liked it?
Yeah, this is the one I use.
Well, there you go. So you can use some of these, funds in here, like a 401k, a savings calculator, all these type of calculators, and then, basically screenshot them and make them part of your report. And so it's not just a gimmick to fill up space, it's also a way to kind of validate what your plan is. Which ones did you use?
I use the 401k calculator and a Roth calculator.
Yeah, well, here's one right here then, the 401k and Roth calculator. And so by just plugging in some numbers, current age, retirement age, annual contribution, total contribution, and it'll tell you where you're at. You know what I mean? It'll also give you these, it's got these sliders on here to adjust things. And it's also got, I'm probably going to work till 70, okay? So anyway, you can move those things around. Annual contribution, let's hope, right now you can be doing almost, depending on your age, around about, let's put it right short of maybe 18 grand. So again, you can switch those things around, look at your things, and it'll actually give you some concrete numbers. Where is their current tax rate? So investment return and taxes, 7% return, 25% tax rate, 15% tax earned. So those are reasonable numbers. You can change them if you want, but 7% return is, I'd say, they were saying 10% before. I don't see the stock market really tearing it up, especially this year. We're on a kind of a down neutral year, so 7% seems pretty reasonable. Anyway, change those numbers around as you want and put that in there. So you can go, and I got to this just by, I'm not here to sell stuff for bank rate, but I mean, you can just go into retirement calculators as well and, look and see what the different products are out there. And also, if you haven't found your mutual fund companies that you were talking about, this will be a way to maybe come across, some of the mutual fund companies. Like I say, Vanguard's got something, TIA, CREF, these guys primarily for teachers and stuff. Vanguard's just kind of a general purpose kind of group. But these guys, I'm not saying to stay away from, but if they start asking, what's your name, what's your email address, be prepared for a deluge of marketing junk. I don't want that at this point. I just want some numbers I can use. So, same sort of sliders though. So if they're not going to ask the personal questions and they'll give me the information I want, I might use them. So anyway, take a look. And by all means, if you already have a mutual fund company, use that as well. But that's a way to kind of, make your term project kind of come alive a little bit in terms of real world numbers and to generate these kind of graphs without this sort of tool would be kind of a pain in the butt. All right?
The project has to be submitted before the 19th?
I'm not so hard over on the dates. Yeah. The main thing is I don't want people like in a crunch at the end. I got finals to do. I need to do this report, and here's a, something I do the night before because I'm in a time crunch. That's why I try to make the deadline early so that people can get it done and out of the way, and you can concentrate on other things. Yes?
So I understand that we're turning in electronically. There must be some sort of link on platform.
Yeah, go in the assignments. Where you been turning in the homework?
Oh, okay.
Yeah. Is it not already there?
Yeah,
I do or do not have it there. Okay, I can add it. It's like easy. I will do that for you now that you guys are ready to do it. All right? Sounds good.